On today's hot sheet, I'm discussing June home price indices from S&P, Cotality, Case-Shiller, and FHFA, and the new home price sales report for July. Today's Tuesday, August 26, 2025. I'm Byron Lazine, and the hot sheet starts now. Live from Naples, Florida. Let me know in the live chat where you're tuning in from, wherever you may be. For those of you, Steve from Naples, right down the road. Loving seeing your face in here, Steve. Good to see you. If you're coming in from the role play, let me know. BAMX members only role play happens every Tuesday at 9 a.m. Eastern, right before this show. Go to school.com/BAMX to make sure you have access to that. I did see Fidel in there. Good to see you from Denver, Colorado. And let's get into it here. We've got S&P indices, S&P Cotality, Case-Shiller. I mean, the name is growing. The S&P Case-Shiller index, as it used to be referred to, now Cotality shoved their name in there after their rebrand from CoreLogic. Just a complete word salad from the S&P Case-Shiller index. But Case-Shiller, historically, the gold standard of price indexes or indices. And we've got our June 2025 report. What we've seen throughout the back half of the spring, as we've collected this data on home prices, is that we've actually seen price appreciation shrink considerably, and it's shrinking at a rate that tells us, hey, by the couple months down the road here, we could start seeing national home prices even be just slightly under flat. Okay, that would give a lot of fuel to the doomers. Now, for those of us that are digging this every day, we understand that, hey, well, if prices move sideways for a year, as they have at times in the past, or they move up 1.7%, which is the projections right now from a lot of analysts, somewhere under 2, that in terms of real pricing, that's like home prices going down based on inflation. But if we're looking at this, and even if it dips a half a point, we understand that that's just a market right now that's hung up by rates. And it's moving slowly, 3+ years now of a real estate recession when you look at transactions. And we understand that as those gates open back up, those people waiting on the rate, and those gates open back up, that the dynamic can shift again. Some of this gets soaked up pretty fast. Some of this inventory, okay? Inventory is at the highest level since pre-pandemic, yet nationally still below where we were in 2019. Okay. U.S. National Index, S&P here for the month of June report. U.S. National Index, the 20-city composite and the 10-city composite, all in for June and all displaying growth. So U.S. up to 1.9%. Again, when you look at consider real prices, that would be kind of net negative on home prices, factoring inflation. 20-city composite coming in at 2.1, and the 10-city composite coming in at 2.6%. Okay, New York continues to carry the flag as the big gainer on home prices according to S&P as they look at these regions. Okay. Just take a look at the 10-city, 20-city, and national numbers going back to 1987. I'm waiting for the market to crash. Well, I guess you're waiting for another never-seen-before mortgage crisis, because without that, what do real estate prices do? They go up into the right consistently over time. We've got 60, 70 years of pretty substantial data that suggests home prices just don't go down. Maybe they go flat for a year, but they don't go down on any given year without a mortgage crisis. And we've only seen one of those ever. Okay. Here's the 20-city composite according to S&P Case-Shiller data. Okay. Atlanta coming in, the June change is down 0.01%. So let's go through and see who's actually in the negative. I mean, to me, this is flat, but technically in the negatives from the June report. So May to June percent change. Okay, you've got Denver technically there at negative 0.31% for the month. You have Las Vegas there on a 0.03% decline for the month. Los Angeles, 0.43% decline. Miami, 0.19% decline. Phoenix, a half a point to the decline. Portland, 0.116 decline. San Diego, 0.31 down. San Francisco, a full point down. Seattle, a third of a point down. And then Washington is 0.52. Okay, so U.S. National being held up by places like Chicago on the 20 city. And where's New York coming in? New York City is only up a third of a point. So out of the 20 city composite, month over month, because remember this line here is month over month is showing that, because this is lagging data. Okay, like we've seen other reports on prices where it's like, oh, we're getting pretty close. Like in another month, we're going to be talking about 0% on year over year appreciation, or we're going to be talking about potentially, a tick under 0% nationally. S&P is lagging data. Okay, it's Labor Day weekend. It's fantasy football draft weekend, and college football starts, and the NFL starts next week. We're into September, and we're just now getting the June report from Case-Shiller. It's rear view mirror looking data. We've seen enough real-time data now into July where we're like, oh yeah, this fall, we're going to be looking at year over year data that suggests we have real prices declining or barely above 0%. Even June for S&P coming in, under 2% on year over year home price growth nationally. It's nothing. Okay. So month over month, most of the 20 city back in June were on the decline. It only gets, I would say more to the downside. These aren't, you're not falling out of your chair with these numbers, but the downside on prices, on pressure on prices, only increases as we go further into the year. Year over year percent change, Atlanta's holding on at a 0.9% increase. You have the Northeast and some of the Eastern Seaboard and some of the Midwest, Midwest states or cities that are still performing well on their year over year metric. And that's all driven by the inventory issues that those places are still faced with. Boston, Charlotte, Chicago, New York City at 7% year over year. Okay. Cleveland, Midwest town. But here's where we're at on negative home price appreciation year over year on some of these cities inside the 20 city composite. You have Tampa there at negative 2.38%. You have San Francisco at negative 2%. You have San Diego at over 0.5% down. You have Phoenix basically flat right now, but down 0.06%. Miami down 0.25%. Denver's down 0.5%. And Dallas is down about a full percentage. Okay. The areas where inventory is high: Dallas, Denver, Tampa. Okay. That's where you're seeing the most pressure on prices. That's also where builders have a significant amount of pressure. Okay. So there's your Dow Jones update so far, or for June. We'll continue to look forward. In 30 days, we'll finally get July. We'll be, we'll see Halloween decorations by the time we get there. All right. FHFA comes out with their report in alignment here with S&P Case-Shiller. Okay. So Straight out of DC from Bill Pulte's desk, FHFA announces that U.S. home prices went up 2.9% year over year. So FHFA looking at U.S. home prices being up more than the Case-Shiller numbers. Okay. This is 2.9% between second quarter of 24 and second quarter of 25. So looking at it through June, just as Case-Shiller was, according to the U.S. Federal Housing Price Index. House prices for the second quarter of 2025 remain unchanged compared to the first quarter. Okay. House prices rose in 46 states between the second quarter of 24 and the second quarter of 25. Here are the 5 states with the highest annual appreciation. No surprise to me, the top 3 all dealing with the lowest levels of inventory across the country. That's New York at 8%, Connecticut at 7.8%, and Jersey at 7.5. With those 3, the tri-state area, if you're from the Northeast, New York, Jersey, Connecticut, considered the tri-state. You have Mississippi and Illinois. Mississippi at 7.3%, Illinois at 6.7%. House prices were down in 4 states and DC. DC experienced the most significant price decline at 7.6%. Okay. So year over year, you now have 4 states and DC that you actually have year over year home price declines. Okay. Home prices did rise in 81 of the 100 largest metropolitan areas over the previous 4 quarters. The annual price increase was greatest in Rochester, New York, and Sarasota had the Sarasota area, the greater Sarasota area had the largest decline at 11.2%. So still a bifurcated market. You're seeing, double digits in some areas and double digit declines in other areas. For the most part, the country is kind of moving sideways here. All right. Quarter 2, 2025 at 2.9%. This is the smallest number going back to 2015 on any quarter 2 year over year. All right. We're looking at all the quarter 2s going back 10 years. And this would be the smallest year over year gain at truly the end of the spring market, the end of June, end of quarter 2, according to FHFA, 2.9%. Back in 2023, end of quarter 2, we saw a 3% gain. Last year, we had a 5.9% year over year gain, obviously well off of the 21 and 22 levels, which were up both at 17% plus each. Okay. Home price appreciation for the U.S. Here's what it looks like. Here are the states where it is not appreciating. Okay. Florida down year over year, according to FHFA, 1.4%. Arizona down 0.4%. Colorado down 0.6%. And then Vermont, interestingly enough, up there in the Northeast, down 0.1% on home prices. DC would be the 5th area. I don't know why we can't just call DC a state. We always have to pretend like they're the 51st state. No offense to my DC people. But the flag does fit better with 50 stars on it. DC down 7.6%, carving that metropolitan area out and highlighting it as one of the areas where we've seen year over year home price decline. So California hanging tough, 0.4% increase year over year. Texas hanging tough, 0.6% increase. And if I had to project forward and we look at the end of quarter 3, you could see those numbers in the negative, reflective of a year over year metric on home price appreciation. And you can see that the Northeast and the Midwest here, for the most part, have the highest numbers on home price appreciation. So those are the 4 quarter increases as of the end of quarter 2. Maybe my favorite one single line chart that I look at every month and just say, hey, send this to a buyer who is waiting for the shoe to drop. This is what home prices do over time. If you're staying in your home for 10, 12 years, let's figure out a plan on how you can maximize that spend. You're going to be paying somebody else's mortgage or your own over the next 10 or 12 years. That chart kind of brings it all to light for a lot of buyers. Like, wow, home prices really do never go down, do they? They always do go up and to the right. Okay. Let's take a look at some of the quick metropolitan areas here from FHFA. If we're looking at the top 100 metro areas in terms of price appreciation, we have Rochester, New York, again, as mentioned previously, at 10% year over year, quarter over quarter, 3.4%. Hartford comes in year over year at 9.4%, and quarter over quarter, 1.8%. New York, Jersey City, 7.9, 2.2. So tri-state area is all up in the top 5, because following New York City, you have New Brunswick, Jersey, and then Buffalo, New York is rounding out the top 5. You have New York, Jersey, or the one Connecticut there in 8 of the top 10. Elgin, Illinois slips in. Columbia, South Carolina slips into the top 10. Coming out of the top 10, Virginia Beach is at a 6.4%. But if you look at Virginia Beach and then even Newark at 10, those are the first 2 on the list where you saw quarter over quarter declines. So as you move forward throughout the rest of the year, if you're seeing quarter declines, or places like Albany, which is only a 0.5 point up quarter over quarter, and Nassau County only 0.2%, expect this year over year number to get smaller. The amount of appreciation year over year is going to start to shrink. It's going to start to decline as we look backwards, especially on quarter 3 and quarter 4, when we get those seasonal declines anyway. You got Louisville and Chicago, Cleveland, Philly, Camden, Jersey, Milwaukee, Anaheim, Bridgeport, Connecticut, Bridgeport, Stamford, Danbury. So really Fairfield County, Connecticut, the way they're looking at that. Allentown, Pennsylvania, coming in at number 20. Okay, flipping this to, these are the top 100 metros. You're going to see a lot of Florida and Texas, I would imagine, here at the bottom of the list. If we go to the bottom, again, as previously mentioned, Sarasota. Then you have Cape Coral, Fort Myers, just north of where I'm sitting right now. That area is down 9% and 4.7% quarter over quarter. Okay, Cape Coral, quoted by Wall Street Journal as being the worst market in America. Well, maybe Sarasota said, hey, hold my high noon, Cape Coral. I'm coming for the crown. Lakeland, Winter Haven, Florida is 98th out of the 100. You've got here in the bottom 10, you also have Stockton, California, Tucson, Arizona. Shout out to the birthplace of the broke agent. St. Petersburg, San Jose, California, Austin, Texas remains in that bottom, category as it pertains to home price growth. Austin, though, has really become an affordability kind of North Star for other cities. The way Austin has developed, it's brought up a lot of affordability. So dumping a ton of inventory in one place over a prolonged period of time can put pressure down on prices. Austin is the example of that. Oakland, Charleston, and North Charleston, South Carolina. And then you've got Tampa in that bottom 10. Okay. So a lot of Florida, a lot of Texas. As you go up the list, you see Florida, Texas, California sprinkled in there. Some of these Sun Belt states and some of these Western states really make up that bottom third of the top 100 metros that FHFA is following. Okay. There's your recap on all the home price indices through quarter 2 and through June. Okay. There we go. Let's get to new home sales. This report's coming out. Builders continue to feel the pain. Bill Pulte, he's got his family name on a national home builder for sure. We just came off of FHFA stat. He's trying to drive new change for builders by really helping out with that interest rate. There hasn't been much movement there other than what we covered yesterday in Jerome Powell's comments in Jackson Hole. Builders, obviously, as we've covered here over the last couple of weeks, confidence is down. Home tours is down. Their incentives are up. The buying down of rates, everything that they don't want to do is up, and everything that they want to see is down. Builders are really feeling the pain of this interest-sensitive rate environment that we're in. New homes sold, new houses sold, seasonally adjusted annual rate comes in at 652,000. New houses for sale comes in at 499,000. That's seasonally adjusted. And then the median sale price for new builds comes in at 403,000. These are through July. These July numbers, 403,800. By the way, that's lower than existing single family home sales. So new residential sales, houses sold, new construction, that number ticks down slightly. Okay, let's get into how much down this number went. Sales of new single family homes at the seasonally annual adjusted rate at 652 ticked down 0.6% below June and 8.2% year over year drop. We were at 710,000 this time last year. For sale inventory is 0.6% below June, that 499,000 number. And it's 7.3% above where we were last year. So current months of supply for builders on sitting on their new homes, their new home inventory, which they want to move every 90 days. I got to report numbers to Wall Street. These numbers got to move. It's 9.2 months. That's a buyer's market. I mean, buyers have full control in that negotiation. You know, if you're a smart, savvy buyer working with a great agent, well, positioning yourself as that buyer to get as many of the incentives as you possibly can. Never had more control over the last 5 years than you do right now with builders. The months of supply is virtually unchanged from June, which was sitting at 9.2, and it's 16.5% above last year when we were only at 7.9. So months of supply going the wrong direction for builders, and as is sale price, it's 0.8% below June, even where we were at 407,000, now just under 404,000, and it's almost a full 6% below where builders were last year, where they were more in alignment with existing home sale prices of $429,000. That's your new construction update. Last night, I guess it was last night, or I saw it this morning, the President Trump said, I want to fire this Fed Governor Cook for mortgage fraud. Bill Pulte has been adamant that Ms. Cook was fraudulent in mortgage applications, getting two mortgages within 2 weeks of each other, claiming that both are her primary residence. And she came out today and said, or this morning or last night, whenever all this kind of was happening, and said, Trump fired me. Lisa Cook's her name. But he's got no authority to do that, and I'm not leaving. She pulls the Leo in Wolf of Wall Street. Here's the recap quickly. We're not going to get into too much of this. It's just a lot of noise. Removing Fed Reserve Board Governor Lisa Cook. There's been a shakeup. There's been kind of a mutiny going on in the Fed, and there's a lot of pressure on Powell. He finally cracked in what I would consider the right direction as it relates to rates, with his comments at Jackson Hole. So Trump and Bill Pulte are claiming that Cook made these false statements on one or more mortgage agreements. Cook's not going to resign, and this thing's probably going to get litigated. So the only reason I bring that up, it was interesting to just kind of see, what's this going to mean for rates? How's the market going to react? And, another shift in the news here, and we want to look at market reactions. 10 years so far, really primarily unchanged. It kind of bounced up a little bit here off the 8 o'clock hour, and it's been hanging around 4.283. It's still relatively low level for the last 5 days, and relatively low over the last 90 days. So should keep rates, with the spread starting to cooperate a little bit more on the 30-year fixed, down in this range that we've seen it, which is near or at year-to-date lows. Obviously, Friday was a year-to-date low at 6.52. We ticked up yesterday at 6.54 to start the week. Just checking in on our friends over at CME Group. with 22 days before the next Fed meeting and this Fed governor news, if you will, here today. Another day of absorbing Jerome Powell statements and this news between Trump and Fed Governor Cook has really unchanged CME's outlook. 88% chance. That's actually up a little bit from yesterday on the probability that there will be a rate cut in September. Okay. I got word yesterday from the BAM team that I think we're going to announce it here today or tomorrow, that BAM camp in Scottsdale is, I know we're a full month out here. That BAM camp is sold out. I don't know if the website does still say you could buy. Maybe you still could, but that announcement's coming. So if you were waiting, I don't know, go on the website, bamcamp.live, see if you can get, maybe they're leaving it open for another day, but essentially I'm hearing it's sold out and that announcement's coming. So looking forward to seeing a bunch of you there to make sure that you hear about all of our events first, everything that we do first. Make sure you're in BAMX. Okay. Go to bamxschool.com/BAMX. We make all of our announcements first to the community, and you get all our new content every single week done for you, templates, email scripts, just emails done for you, blogs done for you, all in our Friday drop classroom, new this week, as well as all of the hot sheet templates each and every single day uploaded directly for you. All the slides that I use rather for the hot sheet are uploaded, as well as the show notes, how we make the cake here for the hot sheet. And if you were coming into the show, so what are they talking about with the live role play every Tuesday, 9 a.m. before the hot sheet goes live? Myself, Tom Tooley's tonight do a live role play, members only. All right. So that's at school.com/BAMX. Join the community, number one community helping agents close more deals. BAMX. All right. There's your hot sheet for today. I'll see you back here tomorrow. Until then, of course, toodaloo.